An adjunct professor at Montclair State University, Dan Geltrude. Dan, nice to see you. Good morning. Well, it was a pretty good day for investors. Do you think the markets can keep up this momentum?
Well, it was a great day yesterday. Lots of excitement. I would say some of that pertains to, shall we call, a Trump bump. Now, what's behind that? Well, I think there's a lot of hope related to tax cuts, which would be a great thing for Wall Street, and perhaps most importantly, deregulation. And that's why we're seeing a lot of excitement related to the banking industry. So they did very well, and I think they stand to do much better during a Trump presidency. Now, will it last? Well, we always love to see this last, but of course, what will happen is there will be ups and downs throughout the year in the market. But do I think overall that the stock market is going to do very well in 2025? I do think that. Okay,
so you mentioned that will do well under a Trump administration. So let's talk about this CPI data. So now they're showing inflation rose to 2.9% in December. The biggest movers were medical services, transportation services, sheltering costs, and then dining out. So, Dan, the Biden administration, they really never could get inflation rate down to that target 2% goal. How do you think things will fare under President Donald Trump's administration?
Well, inflation has remained stubborn. There's no doubt about that. And I have to say, we have to set expectations here. Once Donald Trump is inaugurated, it doesn't mean that all of a sudden that inflation is going to come down. As a matter of fact, we may actually see a temporary bump up in inflation. And the reason I say that is Donald Trump is very, very focused in on revving up the economy. So we have to give him time to let that work its way through the system. Overall, a strong economy should be bringing down inflation, and I think that will happen, but let's manage those expectations and give President Trump a chance, give him time to work through that.
Yeah, because he certainly has a whole lot to tackle once he enters the White House. So following 5 consecutive weeks of weekly rises, mortgage rates are once again topping 7%. Dan, so when the Fed offered 3 interest rate cuts this year, we were all hoping that mortgages would go down. But now they're higher than they were even before the first rate cut back in September. Dan, do you expect them to go down anytime soon?
Let's look at what drives mortgage rates. People assume automatically that because the Fed lowers interest rates, well, that means mortgage rates should go down. Mortgage rates are far more tied to the 10-year Treasury bond. And what we're seeing right now in Treasury bonds, they're up around or getting close to 5%. That's extraordinarily high. So because that's high, that is driving mortgage rates higher because the 10-year Treasury is the benchmark for mortgage rates. So until we start to see that 10-year Treasury start to come down, we are not going to see mortgage rates come down just yet. I think they're going to stay up for quite some time.
Yeah, and our good friend Seth Denson, he's been hitting that 10-year Treasury over and over again as well. And really, a lot of the blame does have to go on that. Meta announcing its plans to cut the lowest performing 5% of its 72,000 workers. Layoffs aren't expected until February, and the plans to replace the workers after it raises its performance bar. This change coming after the company announced just last week it would move away from independent fact checkers and just introduce a feature that would have users contextualize the posts through community notes, similar to what we're seeing over on X. Meta also saying it's moving its content monitoring offices from California to Texas. Interesting moves, a lot of kind of following in the footsteps of Elon Musk and X here, Dan.
Well, listen, Meta is not the only big tech company that is reducing its workforce. The reasons that Zuckerberg is making reference to in terms of, well, we're going to get rid of low performers. That may be true. But what I really think is going on here, because it's an industry-wide thing, is these companies are moving far more to AI, artificial intelligence. And that boom is creating more efficiency and less need for human interaction. So I believe we're going to continue to see more cuts in the labor force as we continue to see AI rise.
So don't take everything at face value. There's always something kind of behind what's really happening behind the scenes there. Dan Geltrude, thank you so much for joining us this morning. So great to see you.
Thanks, Alex.